Inflation is still too high, as this morning's report on the Consumer Price Index showed. And even if you're watching this video years after April 2023, when I'm recording it, business leaders need to understand some fundamentals about inflation, because inflation reflects the price increases that businesses can get for their goods or services. Inflation reflects cost increases, both for materials as well as labor. And inflation will impact the Federal Reserve's decision on interest rates. So business implications of understanding inflation are very strong. I'm Dr. Bill Connerly. I connect the dots between the economy and business, and I want to talk about how we economists look at inflation. Inflation, as you know, has been running high. As I record this, the rate of change is coming down, but it's still much too high. How do we economists think about inflation from a forecasting perspective? And I would suggest, rather than like public policy, business leaders think, hey, what does this mean for the decisions that I'm going to have to make? We can look at inflation in either of two ways. We can start looking at inflation and then say it's a top-down approach. Top-down is our jargon for look at the big picture first. Aggregate demand for goods and services in the whole economy compared to aggregate supply. That is the macroeconomic approach, but when you read the press reports about today's inflation report, you'll get a different approach, because the journalists tend to look at the microeconomics, all the different components. In this chart, I'm showing 6 different components, but there are over 300 components that make up the Consumer Price Index. And incidentally, the Federal Reserve looks at a different index, but it's also made up of many components with data coming from the Consumer Price Index. But which of these two approaches is more valuable? We started looking at the bottoms-up approach when we had a couple of oil shocks in the 1970s. So first we had the OPEC oil embargo in 1973, and oil prices quadrupled in short order. And then in 1979, the Iranian Revolution caused that country's oil to go off the market, doubling prices from their already elevated level. So at that point, we said, hey, we cannot just look at aggregate demand and aggregate supply. We have to look at the details. Usually those details are not important. And we will see press reports saying, oh, inflation is up because of housing. Inflation is up because of eggs or something like that. But most of the time, but not always, aggregate demand and aggregate supply tells the story. So let's review where we have been with aggregate demand and aggregate supply. The Federal Reserve produced a lot of monetary stimulus to the economy in the pandemic. That has continued. This data goes through the end of 2022. The first couple of months of 2023, we've seen an itsy-bitsy little tiny decline, not much to think about. Many people, instead of looking at monetary policy, want to look at fiscal policy. And we have the federal government's deficit, and obviously it's red ink. And fiscal year 2022, not as much. But if you look at the trend before the pandemic, 2022 was still a very big year for fiscal stimulus. Now, think back to the pandemic, 2020, stimulus checks went out, and there were more generous social welfare programs, plus very low interest rates. And suddenly we looked at the details of the Consumer Price Index and we said, used cars are more expensive. Well, do you think there was a cartel that was cutting off the supply of used cars? That's not what's happening. When we have excessive aggregate stimulus, It does not show up everywhere all at once. It shows up in those things that people can buy quickly and which are in limited supply. So let's take a used car. I have a stimulus check. I feel confident about my job. An easy way to spend the money is to upgrade my wheels. And most car purchases are used cars rather than new cars. So people said, hey, let's go out and trade in our 6-year-old car for a 3-year-old car. But there weren't that many 3-year-old cars being produced, and demand surged, but there was no increase in supply. I've done the calculation using my handy-dandy abacus, and I figure that it takes about 3 years to make a 3-year-old used car. So demand for those 3-year-old used cars went up, but the supply did not. Was that a supply chain problem? Was that a specific issue? No, that was aggregate demand showing up in one particular area. Now, another family might have said, hey, we have more money. We're going to upgrade our diet. And instead of eating chicken 4 times a week, we're going to have chicken once a week and go to steak the other 3 nights. That does not show up immediately. It shows up gradually over the course of the year, and gradually enough that the suppliers can adjust to it, unlike what we saw with used cars. So most of the time, it makes a lot more sense to focus on the aggregate demand and aggregate supply. But occasionally when things go really wild, you do want to look at those specific elements. And that, I think, is the best way to look at inflation from a forecasting perspective, which is the business perspective of what does this mean for the decisions that my business is facing right now. I'm Dr. Bill Connerly. I connect the dots between the economy and business. I put out a newsletter. It's a graphical summary of what's going on in the economy. You can digest it in 60 seconds, maybe 70 seconds if you want to ponder the charts, and I'd be happy to share that with you. Just use this QR code and you'll get to subscribe. I'm Dr. Bill Connerly, and thanks for watching.